Hello, and I welcome you to today's Trading Spotlight webinar together with Admirals. It's Friday, the 6th of October, 2023, and together we want to cover the news event of the day. So the non-farm payrolls, crushing numbers. You probably have seen that. We will go through them in a few seconds. Surprisingly, I would say, after the release of the ADP data set on Wednesday. 2 days ago, disappointing numbers from the ADP with 89,000, but now crushing job numbers with the non-farm payrolls, even though you have to some kind read between the lines. 336 against 170, so much better than expected, nearly double the expectation. But if you carefully watch, then you will see that most of the jobs were in fact part-time jobs, not full-time jobs, and the private sector, in fact, shed some numbers too here. In fact, I think over, let me just check this out. How much? Minus 399 unadjusted private sector payrolls, minus 399. So unadjusted data shows that 466,000 jobs were shed in September. So it's, I'm not really sure. I'm not really sure whether this in fact justifies a more restrictive stance from the Fed. But this is at least what the yield market plays. Have a look at the current developments in the current developments in the yield market. You probably have seen that. So the recent drop in equities, especially, so spider Qs, for example, but also gold, certainly, after the Fed is telling. So market is expecting the Fed to stay higher for longer. So in fact, that was what the dot plot suggested on the 20th of September, so around 2 weeks ago, 2.5 weeks ago. And this is exactly the reason, my personal opinion, why the market is dropping right now. But you can see that the numbers are not that strong overall when it comes to the overall economy. And so, long thing short, you have to be a little careful. Let's see what the market makes out of this. So all in all, we can see the initial reaction. We can see gold under pressure. We can see dollar rising. We can see spikes in yields higher. So TLT, for example, so the ETF on 20-year plus bonds dropping again to new multi-year lows, I think. I'm not sure. Yeah, but I think so. I think these are the highest levels in yields since 2007. Very one-sided sentiment. So one might say, well, probably we get to see a bounce. I was already skeptical after we didn't see it on Wednesday, in fact. And in the morning, a client of mine asked me, said, hey, Jens, what can we make of this? I said, well, somehow something's not right here. Even if numbers come in lower than expected, chances are high that we haven't yet seen the lows. Now numbers come in quite hot and we dropped. But again, let's see how this plays out in around 25 minutes from now and what we can make out of this. Before we start, so I'm talking and longer and then longer and longer. Before we start, first of all, we want to have a look here at the risk disclaimer. You've probably already seen that I was digging deeper into the market and what to expect, what to make out of price action, and so on and so forth. So today we are talking about leverage products. So we're talking about CFDs, and they are not suitable for all investors. Before we start trading, please make sure that you understand all risks involved. Read the risk disclaimer right here carefully. Read it, check it out on the website, admiralmarkets.com. Check it out there. Make sure that you understand all risks involved. And in addition to that, also, please make sure that you consult a financial advisor if you're not sure whether to invest in these products, whether to trade these products. Everything I present to you, please don't take it as financial advice or something like that. It's not. It's purely educational, purely informative. You can ask all your questions, sure. Ask your questions here in the chat right now in the live event. Please also feel free to ask your questions in the comment section if you're watching this now on YouTube. Comment, check out the subscribe button, but also leave a thumb up here if you like what you're seeing. But again, no financial advice whatsoever. Please don't misunderstand that. And here, Admirals as a broker, quick introduction, one world, one broker. But first of all, what we want to make sure is we want to answer this question so that we are all on the same page, that we are all theoretic wise know what we're talking about, what are employment numbers of interest, and then we will dig deeper into the MetaTrader here and check out the charts and everything. So first of all, why are employment numbers of interest? So confidence, I have kind of a chain here, let's say. So we're following a chain so that you get a rough overview of why this number is of importance for us as traders, respectively for us as investors. So if the overall confidence in the economy, respectively, in the overall political situation is good, then you will naturally see people looking into a prosperous future. So that's at least what theory tells us. And that will naturally result, we will go here through the manufacturing side. Certainly, we could also go through the non-manufacturing side, look at services, but we are focusing here on the manufacturing side to make things easier to understand, easier to grasp. So that's why I'm saying it's an increase in orders in factory. So people will say, hey, I'm happy with the overall political situation, looks stable, I have a good job, which pays good money, or I have, as a self-employed, I have a very successful business running. My services, what I manufacture, whatever, is looking good. So you will naturally say, well, I get more money. Okay, I'm confident that the political situation will present itself stable. Respectively, politicians will do a good job. Make sure that there's more investment happening here. So I will take risks. Respectively, I will buy more, consume more. That's probably an easy way to put it. So that will naturally result in orders and factories will increase. So the resulting industrial production, increase in industrial production, results out of the fact that the companies producing the goods, we are looking here again at the manufacturing side, will meet the higher demand through more investments. So they will say, hey, people are obviously having more money. They are looking into a prosperous future. They are, I don't know, settling down, buying houses, having a family, whatever. And so, well, we have to meet this higher demand, which means, well, obviously we have to produce more. If you want to produce more, well, you have to hire more people. So that's why you hire more workers, which then want to be compensated accordingly, because you're not the only game in town, let's say. So there's more than one company producing good XYZ. Which means if you want to have the best people producing the best goods, which are then seeing high demand, you can sell for a higher price, let's say, well, you have to hire the best people. You have to compensate them accordingly. So you can say, well, I won't compensate you, or I compensate you badly, but still, please work for me. That's not the game how it works. So if you don't compensate them accordingly, well, people will just look for another job, look for another company which pays more to produce at the end of the day the same product. So compensating them accordingly, or paying them high wages, well, that means they have more money. So you see naturally an increase in average hourly earnings, or average hourly wages. So that's one of the numbers which you will also see being published from the Bureau of Labor Statistics around the Non-Farm Payrolls release. And so if people have more money, well, that means they will consume more. You have a higher propensity to consume, right? That means if you don't have to pay, as we in Germany right now have to pay enormous sums for electricity, or for I think let's call it essentials in the supermarket, bread and so on and so forth, because inflation is spinning out of control. But you have more money at your end. Well, if you have more money, you can save or you can consume. There's a natural tendency that you consume more, which means you have higher economic growth, because there's a natural positive feedback loop in this regard, because you have more money, you spend more. If you spend more, well, you obviously need more products being produced, and thus you have a accelerating cycle in this regard, which then naturally results in companies saying, hey, if the people are consuming, we can naturally hike prices. So because people are willing to pay more, why shouldn't we hike prices then, especially if the prices themselves are probably rising due to whatever reason. So you see a natural increase in inflation in this regard. And this usually motivates central banks then to hike interest rates to avoid an overheating of the economy. So this is usually the natural process. So what we are currently witnessing is the rising inflation. It's not rising because people are looking into a great future, or people are so happy and have great jobs which are paying enormous salaries. But in fact, we see the natural result out of the policy around the COVID lockdowns and what we just witnessed there. So what happened was people were locked at home, so not allowed to go out. We shut down the overall economy, say, hey guys, there's no goods being produced. And to make sure that people stay calm and don't get out of control, you said, well, and therefore we compensate you. So we create money out of nothing. We hand it over. We call this in the US, for example, stimulus checks. In Germany, I'm not even sure how this was called. So I never requested this. Obviously, I don't need it because I'm working from home. I'm doing research for brokers. I'm holding webinars, or I'm also trading the market. So that's my job. That was before COVID and now after. So nothing changed here for me. So I never requested these. But long thing short, there were these stimulus checks being handed out, and the people now had more money while there were not enough goods being produced. Then we reopened the economy, and these dollars, which were handed out while nothing was produced, they were created out of thin air, are now chasing fewer goods. What happens? Well, prices go up. This is how inflation is created. It has nothing to do with the invasion of the Ukraine from Russia or something like that. Well, certainly there was a further push higher in producer prices. You can see this and check this out yourself. For example, on trading economics, check out the producer price development, inflation, everything. But inflation already started to gain momentum and accelerated massively over the course of the year of 2021. The invasion of the Ukraine from Russia, Putinflation, we called this in the media, that happened early 2022. So obviously it was provoked by the governments around the globe, especially the Western governments around the globe, with their policy that inflation rages now out of control. And now you try to bring this genie back into the bottle if you want. But you can't. It's like a bottle of ketchup. That's probably a good way to put it. So it's like you have a bottle of ketchup. You have your fries right in front of you on your plate, and you're shaking this bottle of ketchup, and nothing comes out of it. Nothing comes out of it, and then flush. You have a big ketchup portion, let's say, on your fries, which is way too much. But well, you can't really how can I say that? You can't really manage how much comes out of these glass bottles. So today we are working with better ways to manage the portion at the end. But this is how inflation raged out of control. It had nothing to do with people looking into prosperous future, jobs paying more, and so on and so forth. Now the companies are told, hey, pay us more money or else we leave and go somewhere else, because people they can't afford essentials any further. And so you don't have a classic positive feedback loop in this regard, but one which was provoked by the governments, in fact, in terms of how inflation got out of control. I mean, it's roughly speaking, so I don't get into too many details here, but this is in fact what happened, and everyone can see it right now. So it's no conspiracy theory or something like that. Everyone can see it, everyone can feel it. Just go to the supermarket and look at what bread is currently costing, and then compare it to the price 4 years ago. Well, and so long thing short, this is why the employment numbers are of interest, because this is obviously interconnected. Because you say in a perfect world, let's say, the more people have a job, the better an economy should be running. which should naturally result in inflation picking up in this regard or staying at an elevated level. So we got inflation out of control, and now you see that the overall employment situation starts to somehow look better, which means the better the situation looks, the longer the Fed, after the very aggressive rate hike cycle over the course of the year 2022, can keep rates at this elevated level. Which means then you have rates at an elevated level, which is then dampening the overall business activity, let's say. So there were many unprofitable businesses, or, well, let's say the profit margin was quite slim, even with all this cheap liquidity, which was pumped into the overall economy in the US, in Europe, and Japan, wherever. You really saw a zombification of the overall economy, because very unprofitable businesses, they were profitable, hiring people, handing out jobs. And right now, money is getting more expensive because of the raging inflation. And now these businesses can't keep their head above water. So, well, and they have to fire the people now, which are looking for a job, which is right now what's currently happening, and which will naturally result rather sooner or later in a natural increase, especially when it comes to the unemployment rate in this regard. So because now you will see, we are looking at the non-farm payrolls today, but we are not looking at the naked number itself, because here you have to read between the lines. I will show you what I'm talking about: full-time, part-time jobs, and so on and so forth. But before we head into this and then into the charts, let's first of all have a look here at the so-called Fed Watch tool. I snapshotted it after the numbers were released. And so what we're currently witnessing here is that right now for December, which is very interesting, we're currently seeing that the market is now expecting the Fed to keep rates at the current level and not hiking it, as the dot plot suggested, which is very interesting, because you might say, hey, if the Fed already told us around 2 weeks ago, 2.5 weeks ago, that there will be another rate hike, this is what the Fed dot plot suggested. So probably recall or review the recording which we uploaded on the YouTube channel from Admirals here. So, well, why is the market then not expecting that the Fed is following through? Well, because if you follow through as the Fed, well, then you're heading into potential trouble. We've already witnessed it in March this year in the banking sector with Signature Bank, with Silicon Valley Bank, with First Republic, all failing due to their involvement in the bond market and betting on the Fed to continue to keep rates at zero, which the Fed obviously didn't. Not sure what the managers were thinking about this, but this is another topic. And now what you see is the longer the Fed keeps rates elevated and potentially increases them even further, even though inflation is already trading way below the current target rate. So inflation numbers which came in, which will be released, by the way, next week again. Is it next week? I'm not sure. Or the week after, I'm not sure. But however, we're way below the target rate, which means if we continue to hold level rates here, even cutting them slightly, you will likely over time bring inflation back to the target rate around 2%. So, and that is illustrated here. So not really sure what to make out of this, to be honest. What we're currently witnessing here, probably it's also, well, we are looking at the future market in this case. So in the expectation, or the options market, in fact, and what the market is expecting, probably it's kind of a hedge. What we're currently seeing, that market participants saying, well, we are hedging here by, for example, buying bonds or something like that, or options on bonds, on TLT, whatever, to make sure that if there's the surprise that there's no further rate hike, then we are compensated. Right now, we are expecting the Fed to follow. Well, probably that's the reason why it is. But however we put this, we now want to make sense of this in terms of looking at the charts. And respectively, before we look at the charts, first of all, we will head over here to the non-farm payrolls release. So I tweeted it. You can see it here. Non-farm payrolls, September 336 versus 170 expected. Way better than expected, which is surprising, because let's just head over here And have a look at the where we have it, countries. There we have the countries. We go to the United States, the labor market, and here at the ADP data set. So ADP, the private sector, came in significantly below. In fact, at the lowest level since January 2021, at 89,000, and we had an expectation of 153. So that was the expectation. So we came in significantly below that. And since we know that there's usually a positive correlation between the non-farm payrolls and the ADP, well, what we would have expected is that now, if we saw such a disappointing print here, that we also are likely to see a disappointing print for the non-farm payrolls too. Well, obviously, no. Obviously, we came in significantly better than expected. You can see here, I'm sorry, that's German. So don't be surprised that you probably ever heard about Arbeitslosenquote before. It's unemployment rate in English. So 3.8%, estimate 3.7. So there's already this tick up I was talking about. Let me just head over here to the unemployment rate. There we have it. And there you can see it. So at 3.8, so that's over the last 5 years. You can see this bottoming out after this, let's call it the COVID spike. And then we came lower, and over the course of the year 2022, we, I think, bottomed out somewhere around 3.2 or something. I'm not really sure. However, so you can see there's kind of a drift higher. And already, I think last month, that was the month before, 3.8. We had a consensus of 3.5%. So you saw that we are coming in 0.3 percentage points higher than expected. And I think this will likely continue now due to the reason I just presented to you. So that many unprofitable businesses, due to this higher rate environment and higher for longer, are not coming back into business, or probably will just drop out of the business cycle. And in addition to that, you can also see that here average hourly earnings 0.2% against 0.3. So long thing short, numbers are very good, even though you have to read between the lines. Let me just check out here if I have the link. 1 second, please. I just hope that this works. It's a fantastic tweet from a FX analyst and trader. So a macro strategist here, you can see, and that's very interesting that what he points out, because now you look at the naked numbers and say, wow, what a crushing report this is. So like really good. No one really expected it. So what you will expect is like yields to spike higher. You will also likely expect in the current environment like gold to drop, which we saw. You will likely expect equities to drop in this environment, due to arguing that you say, hey, higher rates mean that overall this is bad for stocks in the current environment, especially given what we've witnessed. And the interesting thing now is, if you read through this chart here respectively, let me just probably open this. Does it work? No. Okay. Let's put it that way. So it's a little higher. So this is like how can we call this? Subcomponents, probably. That's a good way to put it. So you see here minus 466. So just put things into perspective. I wonder how much of the payrolls upside is to do with seasonal quirks more than anything. So take leisure and hospitality. Official adjusted data shows that here we are at 96,000. But if you look at it, read between the lines, you can see that unadjusted data shows the sector shed 466,000 jobs in September, which makes it like, and again, here, unadjusted private sector payrolls was, for example, minus 399,000, for example. Just remember the numbers we saw here over the course of the last months. Where you have it there. We see overall some solid, strong numbers here, especially with positive pushes higher after we saw a very, I wouldn't call it devastating, but it was kind of a weak release in June. But then you had quite some solid numbers, January especially, 472,000, for example. I remember that once we covered that here in the live event. So long thing short, the question is, how much is how much manipulation do we have in here? And tricks like playing around with the numbers, and then as here Mr. Patel points out, seasonal quirks, he calls it, we get to see here. So is the overall US economy really that strong? Is the employment situation really that strong? In addition to that, there's another tweet. I mean, also something worth noting. I don't expect anything positive here in this regard from an account like Zero Hedge, but let's face it, he points out a very serious point. Full-time workers minus 22,000, part-time workers plus 151,000. So like there's more people now having more than one job, while the full-time workers are just cut, obviously. So that's something, if you can read between lines. And this is not a sign of a very strong economy, let's say, but it shows that people really suffer to make ends meet by having only one job full-time to meet to make ends meet, to pay the bills, and put it that way, but have to obviously take several jobs, which is something to keep in mind, I think, when you look at the numbers and, well, say, well, this is a strong job report. However, so that's certainly something to keep in mind, which makes it likely that we're, to some extent, at the end of the rate hike cycle. Certainly, there will probably one further rate hike, but I think from September onwards here, most likely, yeah, you can see that already, that we start to fully price in around 50 basis points, probably even more than that, depending a little on whether we get to see a further rate hike. But we see that the market is right now expecting the Fed to cut rates from the second half of 2024 onwards, so that we are likely at the end of the rate hike cycle. So you can see it here. So 525 to 550, you can see that over 80% of market participants mid-2024 expecting the Fed to be at the same level as the Fed is right now, even if the Fed decides to hike rates one final time by 25 basis points, for whatever reason, to be honest, because again, inflation already is significantly below the current rate level. So, and this is it. So interesting wise, okay, that's certainly interesting. But the question is, okay, what can we make of this trading wise? So I think we start with the EURUSD, and the USD from here, from July onwards, so around 112, 113 probably, topping out. Since then, so nearly 3 months from there, we've seen a very steep downtrend developing here, which is very interesting, and I think is mainly driven by the overall yields development, especially in the US. So put it differently, I don't have yields prepared here, but I'm sorry, let me just go here. You're probably aware of this. Whoop, let me put it here, of this chart. So we are going to 10-year, where we have it here. So 10-year yields. So you can see here the spike higher because of the better than expected numbers, topping around 4.9. And let's go to a daily chart. And there you can see it. So from here, around, yeah, mid-July onwards, we were around 3.7% for 10 years. And now we are trading 100 basis points higher. So this is certainly one main driver for the current run in the US dollar, which resulted in this quite significant drop or solid downtrend lower, but also certainly a reason why, for example, let's have a look here at the SPDR, so the ETF on the S&P 500. So we topped out, that was at the end of July. So we saw one final run higher, but then we topped out around the yearly highs, and then from there dropped back to this, by the way, purple line, which is the anchored volume weighted average price from the start of the year. So, which is interesting because this is a potential level to watch. And it's falling together, by the way, with the 200 SMA in this regard. So this is a very interesting area. It's not certainly an area which you want to go long against, but you expect the market to potentially stall a little, let's say, or to show kind of a reaction. And certainly a level to watch also in terms of, wow, this is interesting. I didn't see that. So gold is very interesting. We flushed lower and now we are heading higher. That's very strong. Let's just head back to here to the charts and finish here EURUSD. So the thing is, how much of this is priced in right now, especially when reading between the lines in terms of the yield development I was talking about. So right now, I could imagine that we see an initial flush lower as we've seen, and probably now we are likely done on the downside. Even though, and this is why I got a little excited now about gold, I wouldn't necessarily play this here in the EURUSD due to the current developments we've seen in the Eurozone in general, political situation in Germany, especially knowing that Germany is the backbone, the economic backbone of the euro, which means if you're currently following German politics, it's like, well, not sure what to make out of this. It's like I could imagine that the world here outside of Germany is laughing really hard about us in Germany, especially from a political perspective. But that's certainly something which is weighing on the euro in this regard. So the euro against the US dollar is, in my personal opinion, not a good play to play a potential bounce in the US dollar, or if we priced in much of this, yes, that's called yield expectation of the course of the last months. But in this regard, I would head over to gold. And this is like, wow, this is really interesting. Let's move here to, let me check out this chart here, this indicator. So gold really sold off heavily. It all started on the 20th of September with the Fed. We saw the spike, this drive higher for whatever reason. And then we dropped following that the Fed came out quite hawkish with the dot plot, which suggested that the Fed will stay higher for longer in terms of yields. We dropped below 1,930. This is a 30-minute chart, by the way. We did make it above that level. And then that was here on the 25th of September. So last week on Monday, we started to sell out, dropping and then testing 1,900 and even dropping further and accelerating massively on the downside. I was kind of skeptical if we can really follow through here, but then, well, it just broke loose. We just trended aggressively lower. So now, and that's something you can see here with the yield acceleration, especially on the upside. We also accelerated on the downside in gold due to the fact that gold is not paying any dividends or any yields at all. So usually from an environment in which yields rise, which is very interesting. Just think about this. So we've seen that in the chart earlier here, or in the presentation. Let me go here against. I said, well, if there's rising inflation, and usually people think about gold as an inflation hedge. It's not. So that's very interesting. But let this sink in. If you see rising inflation and the central bank is motivated to raise interest rates, usually that results in gold dropping, not rising. So, and that's something to keep in mind. If someone comes out and says, hey, gold is an inflation hedge, no, gold is a hedge in an environment in which yields tend to stay very, very low for an extended period of time, since such a period is usually not very attractive to the underlying fiat currency in this regard. So that's something to keep in mind. But coming back to gold now, so you see there's a massive acceleration on the downside, and we are dropping further down to slightly above 1,800, and then we start to stabilize now. As you can see here, oh, voila. So this is the trading range we are forming. And so you can kind of expect that much of this higher yield expectation is now priced into the chart, even though I was really, and I'm still skeptical. Don't get me wrong, but the price action is very interesting. So that's certainly something to keep in mind, probably for the next week. Let's see how things play out now. But you have the jolts, which came in better than expected, or better than expected. So what are jolts? Jolts are job vacancies. So like a company saying, hey, we are looking for people. We plan to hire people. And you see numbers rising if the company is looking into a prosperous future, naturally, because the company will say, if we have a positive outlook for the overall economy, for our sector in which we are producing goods in or whatever, well, we need to make sure that we have people who can produce the goods, right? So if you have a positive outlook for the overall economy, well, you're hiring more people. That's why jolts get up and push higher or come in surprisingly higher than expected, which is an environment in which the Fed can't really cut rates, which means rates will stay higher than expected, which is not good for gold. So if you then see that the market has already sold out and is not making new lows based on this news, which is usually bearish, well, then things get interesting, because now you could say, hey, probably we are about to see a bottom here. Then the ADP data comes in, and the ADP data is not pushing us above the highs. That was on Wednesday, and that was telling, because that was when I really was like, are we already done on the downside? Let's probably wait for the non-farm payrolls and how the price action plays out, because this is not very strong. Usually you expect after the ADP data set, gold to potentially push higher, at least hold above the jolts highs here, probably see a retracement up to 1,860, 870, something. That's probably something to aim for. And now numbers come in better than expected, as we expect, hotter than expected NFP release. We flush below, and then we are aggressively bought back into the range. I'm not long yet, but if we can hold within this range, and then that's probably here. Draw this in. If we can now go above this range and hold here, this would be a sign for me that we are now done on the downside and want to be long. I want to be long for a swing trade, let's say. So I don't want to be long from an investment perspective or something, because therefore that doesn't look very promising. But I probably see some potential for a retracement. We started at 930 down to 820. This is $120. Probably $60 bounce, so 860, 870, as I already pointed out. That would be a first target on the upside. So something like that, and that's a potential swing scenario I'd be interested in, but I'm not yet interested in it, because I want to see gold breaking and holding above the jolts highs here and holding there. And if we get to see that, that's when I get interested. Let's see, probably most likely risking against the lows of such a consolidation, and then going for a swing up to 860, 870, but only if there's clear signs, clear evidence that we can really gain momentum from there. So that's my take on gold. So right now you can see there's a strong reaction, but now we are flushing back into the range. Let's see just where we are going here with the EURUSD. So back to 05. Let's have a look at what equities are doing. Oh, you don't like this? This is not good, not at all. So let's have a look here at the Qs probably. So I favor the Qs. I favor the Qs usually because we have 100% spot market here, but in this case it's a demo account, so it's delayed data because it's an ETF. Let's have a look then at the Nasdaq in this regard. Go here to a 30-minute time frame, even though it doesn't make sense. To be honest, I have to calculate that first. Usually you want to see that we are holding above the 5-day moving average. The problem is that we have more data here available. It's not 100% right, but probably let's look at it from this perspective first. So we broke the trend higher, and the key level here on the downside is most likely around 14,500 points. My personal, my point of view. So as of now, the Nasdaq, the tech sector in general, presented itself quite stable, let's say. So I'm kind of surprised to see in this case here tech stocks performing better than the overall market, like the S&P 500. But let's see if this is what we get to see right now. So what I'm talking about is what you can see here. So while the S&P 500 already broke significantly here below this blue line, which is the August lows. I'm sorry, yeah, it's the August lows. I'm sorry, it's the August lows. The Nasdaq held this region quite well as of now. Let's see how things play out. If we drop now and close the week below 14,000, let's say 14,400 points, I could imagine that we are potentially headed lower and probably even flushing below 14,000, probably going for 13,600. And the main driver for that probably is the semiconductor space. SMH, for example, is not really looking very strong. I haven't prepared the chart right now, but this is where we find, for example, AMD or NVIDIA, something like that. I'm kind of skeptical. I could imagine that this is probably a driver lower here. And this could also drag the Nasdaq lower in this regard. As of now, we look okay. So I don't want to be involved on the short side as long as we trade above 14,400. But once we drop, I think this could be a sign of further weakness to come. And also, that would go hand in hand, in fact, with the expectation that yields will stay high, respectively, that probably we are not yet done on the upside. Let's probably wait. So right now, my take is that I say, well, I think the market, especially equities, which are currently holding up well in general, roughly speaking, once the market is shifting and you see market turning away from equities over to bonds, due to realizing, hey, this is an attractive yield we're getting here. It's a more attractive yield we get in comparison to the dividend yield, for example, the S&P is paying, while the tech sector in January has kind of trouble, let's say, with many growth stocks not paying dividend at all. That you can get to some extent risk-free 5% for 2 to 10 years, depending a little on your time horizon. That's certainly something to keep an eye on, and why I could imagine that probably we are not yet done. You don't want to be long right now. The reason here for this moving average, I was showing that. If you look at the Qs in this regard, so the ETF on the Nasdaq 500, and here looking at the 100% spot market, if you want, I go with a simple saying that I say, as long as we trade below that, you don't want to be long. You want to wait until we make it back above this moving average 65 on a 30-minute time frame, which is kind of a 5-day moving average. So as long as you trade below that, you don't want to be long. And right now we dropped back below that. We really traded below that in the spider. This is the S&P 500 ETF equivalent. And that's one reason for me to be very, very skeptical in this regard. Even though I would say we're probably the weakest player right now, given on the overall technical situation, is most likely the SMH, so the semiconductor space. And that's it. So I just hope that you take something away from this webinar for your trading for the next days. Again, it looks hot, the sector, the employment situation looks hot. If you read between the lines, it's not hot at all. But the market at least right now is seeing higher rates for longer, which is the main driver for the most recent bearishness, which is kind of like the reason to stay skeptical. Again, if you think we are about to see a top out in yields, have a look at gold. Once we hold above the Joel size 833, 834, and consolidate here, I think that could be a sign that the bottom, at least in gold, is in, and we are probably heading higher from there. Yeah, but let's see how things play out. Let's come back to the presentation and finish here with the last slide. Contact details from Admirals. If you have further questions, please check out the website, admiralmarkets.com. Send an email. If you watch this now on YouTube, leave a thumb up here. Subscribe to the YouTube channel, and happy trading from my end. All the best. Talk to you soon. See you. Bye-bye.